Today I'm going to explain national income concept and methods. This chapter comes from managerial economics. First, we have to discuss about managerial economics. The root of managerial economics spring from microeconomic theory. After the Second World War, in the year of 1951, business sector were in struggling. Business manager faced many problems due to changing business and the consequent variability and predictability of their achievement. That time there was a gap between economic theory and exact procedure. Managerial economics helps to solve the managerial problems with efficient manner. Economist Joel Dean introduced managerial economics to the help of business problems for the business managers. Now, meaning of managerial economics discussed. The branch of economics is essentially concerned with the application of various economic concepts in decision making and also applied problems solving at the level of the firm. Managerial economics works as bridge between economic theory and business practices. Definition: according to H. Spencer and Louis Siegelman defined the integration of economic theory with the business practice for the purpose of facilitating decision making and forward planning by management. Now we are going to the main topic of national income. National income measures the total value of goods and services produced with the economy of a period of time. It gives information about the nation's productive capacity, and economic strength. Definition of national income. According to J.R. Hicks, defined NI as a collection of goods and services reduced to a common basic by being measured in terms of money. This is the concept of national income. There are 7 concepts. The first concept is gross domestic product, short form GDP. Another one is net domestic product. Third, gross national product. Fourth one, net national product. Fifth one, personal income. Sixth one, disposable personal income. The last one, real income. We will discuss briefly one by one. So the first, I take gross domestic product. GDP is the final value of the goods and services produced within the geographical boundaries of a country during a specified period of time, normally within a year. GDP growth rate is an important indicator of the economic performance of a country. Another one is gross national product. GNP is gross domestic product plus net factor income from abroad. GNP measures the monetary value of all the finished goods and services produced by the country's factors of production irrespective of their location. Another one is gross domestic product at current price, gross domestic product at constant price. We will discuss what are the differences between current price and constant price. GDP can be estimated at current prices and constant prices. If the domestic product is estimated on the basis of the prevailing prices, it is called as gross domestic product at current prices. But GDP measured on the basis of some fixed prices, that price is prevailing at a point of time or in some base year, it is known as GDP at constant price or real gross domestic product. Another concept is net domestic product. While we are calculating GDP, no provision is made for depreciation allowances. That is also called as capital consumption allowance. In such situations, gross domestic product will not reveal companies' flow of goods and services through various sectors. It is a part of set aside the form of depreciation allowances. When depreciation allowances is subtracted from gross domestic product, we get net domestic product. NDP equal to GDP minus depreciation. Then we will discuss net national product. It can be derived by subtracting depreciation allowances from gross national product. It can also be found out by adding net factor income from abroad to the net domestic product. This is called as net national product. Then we will discuss about real income. Since national income does not reveal the real state of the economy, the concept of a real income has been used to find out the real income of the economy. A base year is selected and the price level of that year is assumed to be 100. 100 is assumed level. So the formula is real income equals money income divided by price index into 100. Another one is personal income and disposable income. Here personal income and disposable income are two concepts of national income. These two concepts very commonly used in advanced countries. Personal income may be defined as the current income of persons or household from all services. Personal income is not only a measure of production, but disposable incomes, all personal income is not at the disposable to be spent on consumption. Individuals have to pay personal direct taxes to the government. They are free to spend only after the payment of taxes. DPI equal personal income minus personal direct taxes. Next one, methods of measuring national income. There are three methods. The first method is product method. Second method is income method. Third one is expenditure method. First we discuss about product method. Product method is also known as inventory or inventory method. The economy is classified into convenient sectors like agricultural, industrial, direct service and foreign transaction sector where international payments are considered. According to this method, value of output is estimated, value of intermediate goods inputs is deducted from the value of output to obtain gross value added. Another one is income method. The net income received by all citizens of a country in a particular year. Total of net rents, for example, net wages, net interest, and also net profit. It is the income earned by the factors of production of a country. Another one is expenditure method. The total expenditure incurred by the society in a particular year is added together to get that years of national income. Methods over. Now we will discuss about the difficulties in measurement of national income. There are there, but I took only the 5 main categories. First one is non-monetized transaction. This comes under exchange of goods and services which have no monetary payments, like a service rendered out of love, courage, courtesy, in case of any kindness. These are the difficult to include the computation of national income. Another one is unorganized sector. Contribution of unorganized sector are unrecorded. It is very difficult to identify income where it comes from those who do not pay income tax. So these are all unorganized sector. Another one is multiple source of earnings. Part-time activity goes unrecognized and such income is not included in national income. Another one is categorization of goods and services. Some cases, categorization of goods and services as intermediate and final product is not very clear. So we could not categorize of goods and services. Last one is inadequate data. Lack of adequate and reliable data is a major hurdle to the measurement of national income of undeveloped countries. These are the mathematical summaries of various concepts. Formula I given to you. The first formula for GNP at market price. GNP at market price minus depreciation equal to NNP at market price. Then formula of GNP at market price minus net income from abroad equal to GDP at market price. Another one is GNP at market price minus net indirect taxes equal to GNP at factor cost. NNP at market price minus net income from abroad, that is called as NDP at market price. Another one is NNP at market price minus net indirect taxes equal to NNP at factors cost. GDP at market price minus net indirect taxes equal to GDP at factor cost. Another one is GNP at factor cost minus depreciation equal to NNP at factor cost. Another one is NDP at market price minus net indirect taxes equal to NDP at factors cost. Last one, GDP at factor cost minus depreciation equal to NDP at factors cost. If you have any doubt, you can call me girls. Thank you.